This is the Value Investor Podcast with Tracey Ryniec. All things value, all the time.
Welcome back, value investors. We haven't yet gotten the 13F filings in for the fourth quarter, although by the time I'm recording this in the middle of February 2025, we're about to get a bunch of them rolling in. And remember, the 13Fs is what has to be filed 45 days after the end of the quarter by money managers, basically, that have 100 million or more in assets. And so then we can see what stocks they bought and sold the prior quarter. Now, some of Buffett's, some of his filings, he always does the filings, but we sometimes find out what he's been buying and selling if he owns more than a 5% or sometimes more than a 10% position in a certain company. Then it's still delayed slightly, but he does report some of those buying and selling for those outside of the 13F reporting period. But it's been pretty quiet over there in Berkshire Hathaway land. So this week, I did want to talk about Buffett and Berkshire Hathaway, but I wanted to talk about the sales of the Apple stock over the last year. Now, if you remember, it has only been a little about a year since we found out that Buffett started selling in a big way the Apple position. And we had to wait until the annual meeting in May to find out a little bit more information because all we knew was that he had sold some. But then he revealed that one of the reasons was for tax reasons, and that's really all he went into. And then he has continued to sell more of that position, and we're waiting to see if it's even smaller than where it was at the end of the third quarter. So I did take a look actually to see where it was at the end of the third quarter. Okay, so at the end of that quarter, he still had a very big position, but he had sold about 100 million shares or 25% of the entire position. He still has 300 million shares. At the time of this recording, that market value was about $70 billion. And it's now 26.2% of the Berkshire Hathaway portfolio. Remember, before all the selling, it was around 50%, and it had gotten as high off and on over the years as like 55% of the entire equity portfolio. And so he has sold small positions over the years to kind of get it back closer to around 50% and not have it, creep up to 55, 60, 65, that like up there. So we have seen some other selling, but not like this. So it was kind of shocking a year ago when we heard of these big sales, but now we're kind of used to it. So we're waiting for the fourth quarter to come out. But I wanted to just take a look at some of the lessons from these sales. And I think it's important now in 2025 to look back on what he's been doing with Apple in his portfolio, because there is a lot we can learn about how to manage our own portfolio when we get a big winner stock like Apple. I know many of you either own Apple yourself or you have other big winner stocks that you got into just even a couple of years ago that have, well outperformed. And I know many of you have wondered, when do I sell this? And I think many of us thought Buffett would never sell big position in Apple like he has been. So I wanted to go again over some lessons from these sales and how it can help us with our own portfolio positions, Apple or otherwise. So the first lesson, I've kind of alluded to it already, and I just titled it, "Buy and Hold Forever is a Myth." So that has always kind of been the Warren Buffett thing, the time to sell is never. That was always his phrase. And that you bought and held for decades. He has held some of his positions for quite a long period of time. So he has been a buy and hold investor, but buying and holding forever, that hasn't actually been the case. I've talked about it on many other podcasts. Obviously, there was his purchase of IBM, which he bought and then sold within, that was less than a decade. He bought a bunch of airline stocks. That was probably his lieutenants buying those. And then when the pandemic hit, he had no qualms. We're just selling all of this. And he sold all 4 positions for a loss. So buy and hold forever is a myth. Berkshire first started buying Apple in 2016. And as I mentioned earlier, it has sold small amounts over the years, mostly to rebalance, as I mentioned. And Buffett has even called Apple in the annual letter and at shareholder meetings and other places one of the 4 pillars of Berkshire Hathaway, the entire business. It was built on Apple. But then came 2024 and the big sales. So if he started buying in 2016 and sold these big chunks in 2024, that's just 8 years. That's not forever. It's not even a decade. So that's why that's a myth. Things can change in any business, in any investment. It's 18 years since the iPhone. That's a long time. The growth has slowed in many of its business units. The original founder and leader passed away over a decade ago. It has different leadership and management in. And some of that leadership with CEO Tim Cook is probably going to be retiring soon. So things are changing over at Apple in the business. And you, as an investor, have to start asking, we've seen what's happened the last 18 years, what's coming in the next 18 years. So that's why buy and hold for forever is really a myth. It's very difficult for any company to keep its business model going for decade after decade after decade, let alone forever, and most do not. So you as an investor have to stay, on top of what's happening. But it's easy with big winning stocks like an Apple to kind of let it coast. So that brings me to number 2 lesson. Don't fall in love with your stocks. This is a hard one. Buffett clearly has been in love with Apple over the years. You could see it in his interviews, even in the annual meeting. He made it a pillar of the business. He loved the free cash flows. How could you not? It was making billions and billions of dollars. At the time he originally bought it, it was cheap, and he's getting those free cash flows. The brand is one of the strongest in the world, basically. And then look at that stock performance. So it's easy to fall in love with any of your stocks, especially, obviously, these big winners. You probably fall in hate with the ones that go the other way, right? And then ultimately you have to sell those. But the big winners that are really just crushing their business and dominating in their industry, it's easy to become emotional. It's hard to be rational and think like an owner. So a few other examples of falling in love with your stocks that I've seen even just recently. Well, let's start with one that used to be kind of like one of these cult type of stocks. That's what I call them. And those are the type of stocks where, if someone tweets out something negative about the stock, like even just the tiniest thing, they feel the repercussions. People come after them. They tell them, you're lying. This is fake. They don't want to believe any negative stories. They're willing to overlook bad earnings reports, a slowing business, whatever it is, because they are in love with the stock. And one of those stocks from the last decade was Visa, ticker V as in Victor. So people were mostly in love with the stock since its IPO in 2008. It is actually owned by Berkshire Hathaway, but they got in 2011 into Visa and MasterCard. They have not ever added or sold anything out of these positions. So they're just kind of holding them. But a lot of other people did get in that IPO and then were huge believers in Visa because the shares did soar. Over the last 10 years, even, the shares are up 435% versus 194 of the S&P 500. But by 2021, the shares kind of peaked during the pandemic then. So they did rally on the pandemic. And then they peaked in 2021, like a lot of stocks did. And then they, instead of selling off, which a lot of growth stocks did, it just mainly went sideways for several years. So 2022, 2023, just kind of sideways. But that was enough for those who were in love with it all that time to exit their positions, to finally cash in. They thought, maybe this is it. We're not getting any more gains. I'm going to get out. I'm up 1,000% or whatever it was. And nothing wrong with taking any gains. I heard from some of you on Twitter that this is what you did during this time period. Also, the valuation of Visa was in the mid 40s. PE really spiked in 2020, 2021, even though it had strong business, but PE, it just got a little bit too hot, a little bit ahead of itself. And so it was trading at around 45 times, hard to justify even with the growth that it had. And so the stock just went sideways. Earnings kept going up, however, and the valuation actually came down. And now it's trading with a PE of 31. That is much more attractive. It is back to new all-time highs. So it was trading in the upper 20s, now at 31. So looking a little more, pricey here a little bit, but it has a PEG ratio of 2.3. That's not too bad. But the cultiness of Visa went away for a couple of years. And now those original investors who really believed, who did get out, are really not back into Visa. And so now, even though it's back to new highs, you don't see quite as much emotion with Visa. But again, nothing wrong with cashing in on some of your gains on these types of stocks. The other one that I mentioned earlier that I also wanted to talk about, but that is still in the midst of the cult, is Costco, ticker COST, and rightly so. Shares since January 1st of 2005 through February 12th of 2025, so little over 20 years, shares of Costco are up 2,086%. S&P 500 up 400% during that same time period. Over the 10-year stack, so from January 1st, 2015 through February 12th, 2025, Costco now up 646%. S&P, as I mentioned earlier, up 194%. So just crushing it on every metric. People love the stores. Everybody's shopping there. They still release the monthly sales update. They're the only retailer that still does that. They all used to do it, but now they're the only ones still doing monthly updates. Tells you how confident they are in those updates, but these are same store sales. And it's still crushing it here for January, one of their hottest months of the last couple of months in January of 2025 after the holidays. But I was told from a work colleague when I was quizzing him on, why is that? You would think the holiday quarter would be the hotter one or, that month of December. But January was so good because you buy all of that party food, you're hosting all these events during the holidays, and then the food is gone. You have to restock. So you might not be buying holiday gifts and that kind of stuff anymore at Costco, but you go back to restock your food for the rest of winter, basically. So everything runs out and you You're back in the stores in January. So that's what's happening at Costco, but it's better than ever over there. And it was very solid comps coming out for January. So what is my complaint about Costco? Well, it's trading now at its all-time highs with a forward PE of 58.7. It's always been expensive the last couple of years, certainly even since the pandemic hit. It's, never been trading at 25 times in the last 5 years. It has been trading in the upper 30s into the 40s, and now it's trading at 58.7. So that's pretty pricey for what this is as a retailer. And you have to start to look and say, yes, it does have some phenomenal growth right now, but that valuation is, basically one that has never happened with Costco before. And again, it has been pricey for a long, long time. Still have very nice earnings growth expected, but how much are you willing to pay for that earnings growth? Eventually, the market, Mr. Market, says, I'm not willing to pay that anymore. And maybe it'll be a recession or some kind of slowdown. And that will be the catalyst where people will say, you know what, Costco at 60 times, I'm not going to go there because things are slowing. So right now for fiscal 2025, expected to see earnings growth up 11.9%, fiscal 2026 at 9.2%, on revenue growth of 7.4%, and 2026 6.7%. So these are pretty solid numbers, especially for a retailer and one that's been doing it over and over and over again. But again, how much are you willing to pay for it? As value investors, I'm not willing to pay anywhere close to this. But going back to it being a cult stock, this is where it's difficult, right? How not to fall in love. How could you not be in love with it if you've been in it, even just for the last 5 years, not even 10 or 20 years? You are going to be, it's still hitting new highs. And this brings me to my third lesson from Buffett and his Apple sales. You can't market time, like getting out. Apple made a few highs in late 2024, new all-time highs, but Buffett had already been selling billions of the stock. In fact, the stock is up 39% over the last year. So that huge reduction in the Berkshire Hathaway position, down now to just 26% of the total portfolio, missed out on most of that 39% gain. Not all of it, because he still has a big position. But a lot of people bring this up of like, oh, Buffett, bad timing. He was, dumb to get out when he did. And yes, he did miss some of those gains, but that's only in hindsight. Once you decide to sell one of these types of stocks, one of your long-term holdings, a big winner like this, you just kind of have to do it. You put the plan in place, whatever that is. And for Buffett, it clearly was, this has met our goal, whatever his goal was for that particular holding. And maybe other things. He said it was for tax purposes. So it met that. It could have been the valuation. Apple has gotten much more expensive than when he bought it. When he bought it, I think he originally paid under 10 times for the PE. And currently it's trading at 32 times with a PEG of 2.3. So not as expensive as even Costco, but for Apple at its earnings and revenue growth, which is in the single digits, it's, pretty pricey here. So he's taken the position of, we've got what we want out of this stock. We have a huge gain. There is no problems with selling out some of your profits and moving into other things. So, this is the hardest part of the lessons, though. You can't market time. That's why, selling in like more, kind of dollar cost averaging out of a stock can be good for a lot of people because you may still capture some upside while you slowly reduce your position. And, that's not a bad way to go about it on these ones that you've owned for a long time. There's not something wrong with the company, or, it's not blowing up because of some scandal or something. And you have time to just say, hey, this has met all my criteria for an investment, and it's time to cash in and get out. Now, I did take a look at Buffett's other large positions now, because a lot has changed in the portfolio since he's been selling off. Again, we don't yet, as when I'm recording this, have his Q4 changes. So that's coming, and I'll do another podcast on that once we get them. But for now, American Express is now his second largest position at 15.4%. He bought it in the first quarter of 2001. So that one, 24 years he's been in American Express. So he has bought and held quite a longer time period. For that one, let me see. American Express is up. I think this is this is from 2001. American Express is up 748% since he bought it. And I used the last date of that quarter of March. The last date of March, March 30th, 2001. So it's up 748. S&P 500 is up 199% because that decade did include the financial crisis, and it wasn't a great decade, the 2000s for the S&P. Must have been better for American Express because that did better. The NASDAQ, interestingly, since March 30th, 2001 through February 12th, 2025, is up 967%. 967. Almost 1,000% for the NASDAQ. So big difference, NASDAQ and S&P. And that has to do with, what kind of companies are in the NASDAQ. So I took a look at his third position now, which is Coca-Cola. That is still in there. He also goes back to the first quarter of 2001 for Coke, ticker KO for Coke. They just reported another solid earnings report, and that stock is up 421.9% since March 30th, 2001. And again, S&P up 199.4% during that same time period. So both American Express and Coke are outperforming the S&P 500, maybe not as spectacularly as you might think of like a Costco or something like that, but still very nice, very difficult still to beat the S&P 500. Now, what about valuations on these? Why is he still hanging out in American Express and Coke, and he's selling out such a big position in Apple, but Apple still remains the largest position? So he still does have, some belief in the stock, but just reducing. So American Express trading at 20.2 times. That's pretty cheap for this market. PEG of just 1.5. That's pretty cheap as well. Coke is at 23 times now with a PEG of 3.8. So not so cheap on the PEG for Coke. Coke is also a much slower grower now. So 23 times, a little pricey for me to want to pay for Coke here. But those shares have taken off. Let me see. Are we at the new highs on Coke? I haven't looked since it did report those earnings. You also get a nice dividend with both of these. The Coke dividend is almost 3%. So that's pretty nice. Berkshire's been cashing in on that over the years as well. He's talked about that. Let me see. It's not back at the highs, but it did hit the new highs last year in 2024, but it is on the upward swing here a bit. Just looking now, because we do have that earnings report coming in and we have some updated data on Coke. Analysts are cutting those earnings estimates for Coke, actually. Only expected to see earnings growth of 2% here in 2025. and then 7.5% in 2026. They did address some questions about the tariffs, especially on like the cost of, canning, the aluminum. They said it wouldn't be that big of a cost addition for them, but they're so massive in size. I've heard kind of mixed things on the aluminum and the can issue for a lot of these consumer products makers. So it does seem to depend on the size of your company. Some of the craft brewers, for instance, that offer it in the cans, they have said that it is going to be, a item that is passed along to the consumer. It is going to raise prices. But Coke said, not as big of a deal for them, again, because they're so massive. So size does matter on these things and what you can negotiate. So pretty slow growth expected for 2025. You're paying 23 times. That's not cheap to me. I wouldn't be super interested in Coke here as a value investor, but evidently not pricey enough for Buffett to want to sell and cash in some of his profits on that one and move to the sidelines. But these are just a few of the lessons. Also remember, even though he still owns Coke and he has American Express still for 24 years, not everything lasts forever. As we know from Blockbuster Video, right? We even know from DeepSeek now coming out with the news that, kind of blew up the AI space a bit, although maybe they didn't really. But we know this from 3M and their struggles, from Disney and their struggles. It's very difficult to keep a similar business and a similar business model going for decade after decade after decade. We saw some companies achieve close to, 100 years of dominance. I guess we still see that to some extent in like the energy stocks, like an Exxon or a Chevron. They've been around a long time and they still dominate. But outside of commodities, it's so hard to do. Everything is always changing. You have to change along with the technologies. Brands change, loyalties change to those brands. There's new competition, new innovations. And so it's always good to check in on your companies. Even someone like Costco, it's kind of hard to believe that anyone could dethrone Costco, right? But we have plenty of examples of former really well-regarded retailers that are no longer with us, like Sears Roebuck, Woolworths, that was another one, Weebolts, Kmart, Zayre, Venture. I'm listing them all out. And I know what you're saying, but they are better. They aren't Sears, but Sears was king for a long time. So I'm not saying you shouldn't own some of these kind of culty, emotional type of stocks. We all own some of them. But these are lessons to learn from one of the greatest investors ever. And Buffett has managed to sell at least, a huge chunk of one of his 4 pillars. He locked in those gains. He still has a big chunk of it sitting there. If the stock hits another new all-time high, he's still cashing in, but took some profit off when the stock is trading at this valuation. And the business model appears to be changing a bit from when he bought it 9 years ago now. So don't get stuck in your little path and, resist some of the changes. It's hard though. And these are why I watch Buffett and his moves. And I will until he's no longer with us, because, selling Apple and selling a huge chunk, that took a lot, I'm sure. And we all can learn from that. So let me recap some of the tickers I talked about on this week's episode. Of course, there's Apple itself. AAPL is that ticker. We talked about Visa. He owns that in Berkshire Hathaway still. It's a small position, and I'm sure he rues the day he didn't throw, 20 or 30 billion into that one. Ticker V as in Victor. Then I talked about American Express, ticker AXP as in Paul. AXP, there was Costco, COST. Its earnings report's coming up in March. You want to tune into that one. And then there is just Berkshire Hathaway. We've just mentioned it throughout this episode, and I have a podcast from earlier in 2025 about whether or not you should buy Berkshire Hathaway here in 2025. I know many of you listened to that. I wish I could say yes, but go listen to the podcast. It's just a little too pricey for me here. But ticker for Berkshire Hathaway, the B shares, or A shares if you're so inclined. But the B shares, B as in boy, R as in Robert, K, dot or dash, depends on what website you're on, B as in boy. So it has 4 tickers, but it's got that dot in there, BRK dot or period B. And as always, I aim to bring you as many value stocks as I can. On this episode, really, there were no value stocks, even though we're talking about Berkshire Hathaway's portfolio for the most part. What does that say? That could be a whole new podcast into itself about how Berkshire Hathaway no longer owns any value stocks either. But we'll wait and see what else they buy in those 13 Fs. I shouldn't say they don't own any, because some of those energy stocks are looking pretty cheap here. But outside of energy, not a lot of value going on over at Berkshire, as you know, we've had this big market rally and a lot of stocks are near or at their highs. So nothing wrong with that. I'm going to be covering all of these topics as we move forward here in 2025. Be sure to subscribe on Apple. You can get us on YouTube. We have a Zacks podcast page. Many of you subscribing over there. Just put in Zacks podcast and you'll find it. It's not too exciting. It's just our audio podcasts are there. But if you subscribe on the YouTube channel, then you will get all of our podcasts other than the Market Edge, which is a video podcast, and that's on our regular channel. Not to be confusing, we do have 2 channels on YouTube, but you will get the ETF Spotlight and John Blank's great monthly podcast that he does, updating on everything going on in the economy. So you definitely do want to just subscribe and get all of the podcasts there. But make sure you get us somewhere, and I'll see you again next week on the Value Investor Podcast with hopefully some value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.